Now, Asian currencies, excluding the Japanese yen, are up 8% against the U.S. dollar since those March lows. That's measured by the Asia Dollar Index. Meantime, the region's equities have soared 67% since March, as measured by the MSCI Asia Pacific Index. Now, where are the region's assets headed next? Today, our guest, Jimmy Ko, head of Economic-Treasury Research at United Overseas Bank at UOB, may have the answers, and he joins us from our Singapore studios. Jimmy, how are you? Hope you're doing well today.
Hi, Susan. Fine.
Hi, Jimmy. So let's get into our conversation about these assets, shall we? It's interesting because what I'm reading off that really struck me from your notes is that you actually think that Asian stocks will rally for at least another 6 months into March. What makes you so confident?
Well, I guess you see two fronts. One is that if you look at how the environment has been, the most severe part of this crisis is probably behind us when we saw Lehman Brothers failure. That was really, we kind of knew technically what was systemic risk, but we never really experienced systemic risk before until Lehman went under. But that part of the crisis has been resolved. You see, and the liquidity injection on both the fiscal and the monetary front is likely to sustain for a little while more. In fact, when we look at the previous crisis, you look at post-1929, post-1974-75, post-1998, from the rock bottom when it started to appreciate, it usually sustained for about 12 months, and this time our rock bottom was on the 9th of March. Let me put this in perspective. One, you see, when the initial bounce from March to April, everybody thinks that this is a dead cat bounce. By April, they say, well, this is not for real. By May, some people that I was speaking to, they say this is a cyclical bull in a structural bear, which I don't really know what it means. In fact, how it works is that, and you see that as long as you talk to people and there are people who are still negative, that means this thing could still run for a while. Until the most bearish guy being forced to participate in the market, then we will look beyond this. In fact, this time around could be a bit different because if you look at it, so far it's a lot of inventory rebuilding. We came from, it was a normalization from very extreme situation. Are we in the mode to recovery yet? I think the picture is still fairly mixed. But until early part of next year, I think we could see the market sustaining. I'm not saying that this could go another 30 to 40%, but I'm just saying that every time there's pullback, you find that there will be new participants in the system.
Okay, so Jimmy, if an investor is watching right now saying, okay, well, then back it up. What should I be doing with my money if you expect stocks to rally for another 6 months? I put my money into equities right now, all of it?
Well, you see, what we are seeing right now is still a fairly the easy money for this crisis have been made. We saw normalization from equity market to credit market to currency market to property market as well. So going forward right now, actually I was just pulling out some charts before I came here. The STI is close to 2,600. Actually 2,600 to 2,700 are actually levels just before Lehman. So beyond that, I mean, it's just looking at a two-dimensional picture. Beyond that, we really need real demand to kick in. So far, there are some positive signs, but not convincing yet. For every 1% that you speak to who is positive, you can find one who is negative at this point in time. So it's basically
Jimmy,
about selecting.
You mentioned property. Yeah, it's about selecting. And Jimmy, you brought up the property sector as well, which a lot of people have been investing in because there's a lot of fear, of course, of inflation on its way. But do you think the property sector has now built into a bubble, especially in Singapore where you live?
Well, you see how this thing is like. You see the amount of liquidity that's injected into the system. Illiquidity must find a place to park. It either reflects into higher inflation, which is probably going to be a problem years down the road, or higher prices of services. If not, it will be higher prices of assets, and we are seeing that across the region in a significant way. One, the low interest rate environment. Two is the strong balance sheet of Asia individuals as well as corporates. In fact, on the interest rate front is quite unique. Most of the Asia interest rate cost of borrowing is actually tied to the short end of the curve. Whether is it in Singapore, in Hong Kong, you find that a lot of the mortgages are priced with the shorter end of the curve. Whereas in the US, most of the borrowing are actually priced with the 10 years Treasury, which had gone up by about 150 basis points since the beginning of 2008. Whereas in Asia-wise, it has actually come off. So that effectively have reduced the borrowing costs for the Asia markets. Is this a bubble in the making?
Yeah, is it a bubble? Is it a bubble? And what about people who say, can I get in now? into the property sector. What would be your advice?
I wouldn't want to comment whether you want to get in now, because people like us always end up losing money. We say that, in fact, in this crisis, actually the professionals are the one that is left behind. You look at the amount of professional money that has not been invested, because we keep looking at some of the extremely negative things and they think that it could continue to erode. In fact, some say that we are like bad photographs, overexposed, underdeveloped kind of people. If you look at the whether is it a bubble right now or not, by definition, we are not exactly that yet. You see, within the Asia system, there is requirement of down payment of 20%. 80%, then you take up loan. And at this point in time in Singapore, those people who buy have been able to do that, and that means they can take delivery. Going forward, right now, yeah.
Yeah, okay, Jimmy, what a pleasure talking to you today. Thank you for your time. Jimmy Cho of UOB.